Capital Markets Report. This is from Newmark.
This may be my favorite report that came across this week. In the newsletter, I said it was an excellent report. I tried to limit my praise a little bit, but I really like the way it covers all the different kinds of commercial real estate, and it compares them along a lot of different lines. But just as a headline, it said that investment volume in commercial real estate increased by 55.6 year over year in the first quarter of 2022, reaching 170.8 billion, which is the largest first quarter volume on record, overtaking the first quarter of 2007, which you just mentioned. So maybe that's prescient. Yeah. Of the 171 billion roughly of investment in commercial real estate, 63 billion was in multifamily, which is definitely the most sought after property type. And dry powder increased slightly to 250 billion, following another all-time record year for capital deployment last year. Higher inflation is expected to favor property types which have shorter lease terms, such as multifamily and self-storage. And I think that it may be this report or another one that talks about hotel performance and how hotel performance actually, when it comes to occupancy, hotels haven't done as well as they expected because of raising airline rates. But the rents have stayed pretty solid actually.
Yeah.
So,
well, just anecdotally, I'd say, yeah, they're definitely up there. And I've heard that, not to get too much into hospitality, but there's a big bifurcation of like destination hospitality hotels and more of your kind of business travel oriented. I think that I believe hearing from Bloomberg that the vacation travel that's kind of back up, at least like 90% of like pre-pandemic levels, but the business travel is still like 60% or so.
Yeah, that makes a lot of sense.
Like, try to go somewhere with a beach. Prices are sky high; they're fully booked. But go to your Cedar Rapids, Iowa, at the new Holiday Inn. Maybe the occupancy may be hitting, you still can get a good deal.
So I'm glad that you paused on these two pairs of graphs here, and because I really liked, we're talking about inflation and rate hikes, and they right off the bat they have a good comparison of these different property types and how impacted they are by either inflation or by rising interest rates. And the most vulnerable, I thought it was kind of interesting, the most vulnerable when you're talking about rising interest rates is student housing, and then healthcare, medical office, and then office buildings, and on down the line. And the least impacted by rising interest rates are single-family rentals, and then real estate, net lease, multifamily. Multifamily's about on the lower end. Multifamily is 5.5% impact. Student housing is 15.5% impact.
Yeah,
so we're on the lower end when it comes to multifamily. And then just to continue the summary, when it comes to inflation impact, the biggest impact on inflation is net lease, followed by office, and then medical office and healthcare. And then and this is expected, we talked about this, the least inflation impact is hospitality, which is at 0%, virtually not impacted at all.
You're, booking room,
next day.
Selling keys every day.
Yeah. And then self-storage and multifamily is at 0.6% inflation impact compared to the 0 of hospitality, or compared to the 10% of net lease. Multifamily's doing pretty well. Very insulated when it comes to inflation.
And again, back to what we were saying, one of the reasons why we invest in multifamily, you see the Fed printing a bunch of money, the government spending a lot of money. Mm-hmm. Okay, at some point, does that lead to inflation? Wasn't necessarily true the last decade or so, but finally seeing it for this type of event. And by the way, even when we were seeing low rates of inflation, multifamily still performed very well. Mm-hmm. Real estate is a consistent inflation hedge across property types.
So when it this report looks back at CRE returns for all property types and compares them to interest rates really going back to 1979. And for the vast majority of years, the returns for most, if not all, property types beat inflation. Some are beating it a whole lot, and some more than others, obviously. And you can see for the last 2 years, industrial has done
crushed it
since 2016. Yeah. So that's not any news for anyone that's been following commercial real estate. But also, multifamily is up there as well. There's really, I can't see any year where multifamily hasn't significantly outperformed other CRE property types.
Yeah. Interest rates and cap rates not strongly correlated.
So
true, they're not strongly correlated. Matt and I were looking at this graph, this chart yesterday. And so if you're listening to the podcast, we're looking at some charts, and you can watch all these charts on the YouTube channel, the Great Capital YouTube channel. But we're looking at a chart comparing the 10-year Treasury yield and overall cap rates. And I had a couple issues with this. One, the 10-year Treasury they have it at 2.32%. It's, basically 3% plus or minus today. But we'll forgive them for that. But this is a Q1 report, so that makes sense. But cap rates in general are a lagging indicator, because you get the cap rate after it's closed. The purchase price was negotiated maybe 120 days, 90 days. Yeah. Prior to that,
you're looking at the past.
You're looking at maybe a good 3 to 6 months, kind of in arrears. But my gripe with this is good to look at, the 10-year Treasury, because it's such a benchmark. But I think it would be better to look at a host of other financing rates to really see a better correlation. Just like Noah Stone has mentioned, the kind of the more corporate debt side, corporate bonds are a better proxy to figuring out where cap rates are going. But really, the effect of SOFR and the Fed funds rate and the shorter maturity rates, I think, would show a higher degree of correlation. And I think reading between the lines, not strongly correlated does not mean not correlated.
Yeah, there's still a correlation line here. And it seems like as the interest rate rises, the cap rate rises.
Yeah.
There is
it's not
a pattern to the data. Even the low end, you see a big linear line. So But this is what I was going to say before. It's like, it just makes sense, at least on a deal-by-deal level. Let's say, so interest rates rise. That means that the loan that you planned to get for your deal is now going to be not a great loan, and your returns are not going to be as great. And then that goes back, and then you got to go back to your investors, and your investors may say, yeah, I don't like this.
Especially you better a lot of deals something. Where it was skinny beforehand. It was low cash flow, and because people are getting beat up in two places. Mm-hmm. One, on the interest rate, sure, you should have kind of expected to a degree, but even bigger than that is the loan proceeds. Because as your interest rate goes up, it's harder for you to clear the debt service coverage ratio hurdles, and so then all of a sudden they're like, well, not only are we going to give you a higher interest rate, but we're going to give you a smaller loan as well. Mm-hmm. Now, smaller loan typically lower leverage, but it also reduces returns. Yeah, you have to bring more equity to the deal, and so if you were working on a deal that was marginal, you've got a deal that maybe doesn't work anymore.
You go to your investors and you're like, hey, everything's worse. There's a few worse things, and then what are they going to do?
Yeah, well, I think there's a lot of sponsors having to make some hard decisions of like, you better be transparent and open with your investors.
Yes, exactly.
This is what's going on. Or what you're doing to fix it. Mm-hmm. But if you say you signed up for this. You signed up for X, but you're going to get Y, and it's a lot worse.
And that's a major
mistake.
Yeah, and these hard decisions and these hard facts really that are moving the calculation of these deals. I think that's why people are going back and negotiating, and why brokers are really earning their money right now. Yeah. Is because things have changed, and that change needs to be communicated and adjusted across all these different parties, whether it's the lender or the sponsor or the seller. All these people need to kind of get on the same boat, and there's a lot of negotiating to be done.
And I just recommend, there's a lot in there's a 35-page report, a lot of great charts and graphs. Again, I'd recommend checking this out. Hop on over to grayreport.com, sign up for the newsletter, and you will be able to sign up for the newsletter. You're going to get these sent to your inbox every Thursday. Highly, highly recommend it.